everyone. My name is Shayna Orzik-Sissel, and I am the founder and chief executive officer at Banríon Capital Management. And welcome to episode 6 of You Are Doing It Alt Wrong, a show where we spend 5 to 7 minutes taking on myths and misconceptions about alternative investments to help address some of the key concerns that advisors and investors of all types may have about the space. So today's myth is that you have to be an accredited investor or a qualified purchaser to invest in alternatives. This is broadly incorrect. Yes, private funds are a thing, but we have what are called liquid alternatives, and everybody can actually reap the benefits of diversification through alternative investments, even more so now than ever before. So here's a little history lesson. In 2007, the SEC changed the rules as it pertains to alternative investments. What this meant was they relaxed some of the restrictions of the Investment Act of 1940, which is the act that actually monitors and regulates mutual funds, ETFs, anything in that space. Prior to that, there were severe limitations on shorting, on use of derivatives, on liquidity, and things of that nature that prevented alternative types of strategies to be made available to the masses. But this all changed in 2007. And at that time, what most people will remember is that we saw a huge influx of 120-20 and 130-30 mutual funds, where they would go 120% long and 20% short, or 130% long and 30% short, and you had a beta of 1 and 100% long exposure. These aren't truly alternative funds. Quite frankly, they're pretty similar to traditional investments. You're getting similar exposures. The alpha that they're assuming there comes from the manager's ability to short, and as it turns out, shorting is incredibly difficult to do. So most of these products went away, but the structure came from the fact that the SEC allowed for up to 30% shorting of a fund's NAV, net asset value. So we saw that happen. And then shortly thereafter, we saw a lot of hedge funds convert their hedge fund products to mutual funds. And over the years, we've seen the same thing happen in ETFs. And in more recent years, we've had the advent of interval funds. So interval funds are 40 Act compliant, available to anyone, but they have limitations in liquidity. So similar to closed-end funds, they do trade on an open market. They have a ticker, but not the same as closed-end funds. You can't just liquidate at any time. They have limitations to when you can invest and when you can take your money out. It's usually quarterly. And these types of investments are actually making it possible for the average investor to invest in things they never were able to before, things that are relatively illiquid, like venture capital and private equity. Prior to that, anything that was out there in a ETF or mutual fund form was replicated. And what that means is that the return streams were looked at, put into, a mathematical formula, and they attempted to use regression modeling to try to figure out what the key drivers of returns were, and use derivatives mostly to try to replicate that exposure and replicate the return stream. But you weren't actually investing in private equity. You were just trying to replicate the returns and the risk that private equity had. It's not the same, and most of those products were highly unsuccessful. But with interval funds, everything's changed. So what's the point of everything I'm telling you right now? Alternatives are available to everyone. Advisors can invest in alternatives across their book of business. And here at Banríon, that is the key thing that we focus on, is providing turnkey opportunities to provide diversified, low correlation portfolios that you can plug into to your client portfolios. And it doesn't matter if they're accredited or qualified. And we also have an access platform where for your clients that are accredited or qualified, you can find interesting investments. And I think that's the important caveat here is, yes, for some things, you do have to be accredited as defined by the SEC or qualified as defined by the SEC, which does somewhat limit. And that's because these are unregulated pools of money that can't market themselves and that tend to invest in things that are a little more esoteric. And so the hurdles are meant to define a degree of sophistication. There's some rumor that there will be changes to the accredited investor rule, allowing for an exam to be taken so that it's not about just how much your value, your net worth is, how much money you have in the bank, but really is defined by your sophistication as an investor. But that's not here today. But what I hope you take away from this is that you can invest in alternatives no matter what, no matter who you are. There's something out there for you. You just need to know where to look. So if you have questions or concerns, let us know. Please subscribe, like this video, comment if you have ideas for another myth or misconception you'd like to take on, and also make sure you check out our 2 other podcasts, The Alternatives Mason, Building Alternatives Knowledge Brick by Brick with host Brittany Mason, where Brittany talks to folks who are experts in the alt space to learn more about alternative knowledge and how they build portfolios, and are about to be launched What's the Alternative podcast, where we highlight some of the managers that we work with, some of our best ideas, so that you can understand what types of opportunities are out there for you and your clients. Thank you again for watching. Have a great day.